Thanks for tuning into Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with Ed Egalinsky, who is the Managing Director at Direxion, an ETF issuer known for its leveraged and inverse funds. Ed, welcome to the show.
Good seeing you again.
Likewise. So Ed, I know you have a very extensive lineup of single stock ETFs today. For the people watching, I would love it if you could run through what your lineup looks like and maybe tell us a little bit about how it could evolve in the future.
Yeah, sure. For those of you who don't know, Direxion, of course, is most known for tactical trading tools, leverage and inverse ETFs. We have different leverage points, 2, 3x, 1.5 times on the long side, and also leverage points from inverse 1x to inverse 3x on the short side. Most of our ETFs have been broad equity indices, baskets of stocks comprising of an index, or treasuries in terms of the 7 to 10 year and 20 plus year treasury for people that want to trade interest rate movements. More recently, we have launched some leverage and inverse single stock ETFs, and we have now a lineup of 6 of the 7 magnificent 7 of 1.5 times bull, non-leveraged inverse bear on all of those stocks individually, excluding Meta.
How come you don't have Meta? Are you going to launch that one in the future?
Well, there's a possibility. We evaluate in terms of the level of interest, also to determine if we could get to certain leverage points to make it more interesting to clients to trade. So we have looked at a number of different single stocks, including Meta, to potentially add to the lineup if we can do it from a structural standpoint to get the leverage we desire.
Gotcha. So Ed, how have traders been using these single stock ETFs? Are they trading them quite frequently, like day trading them, or are they holding them for many months at a time? Do you have any sense of that?
It's a good question. Of course, these are all designed as short-term trading vehicles and should be monitored on a day-to-day basis. With that said, a number of both sophisticated retail investors and institutions, if they don't want to use margin, here's a way to get that leverage exposure with a single stock at 1.5 times leverage on the long side. So it's a way for people to get that leverage without necessarily needing to institute margin. And of course, with interest rates rising also, there may be more cost to that margin. So this isn't an ETF wrapper. It makes it more viable maybe to get that leverage where your liability is limited to the initial investment. So we're seeing some people speculate, particularly on headlines with those individual stocks. In addition to pre and post earnings, we've had 5 of the 6 single stock leverage and inverse single stock report earnings within the last 6 weeks, with Apple being the most recent one at the beginning of this month. I think Nvidia is towards the end of this month, so it would be the 5 of the 6 so far. On the short side, it's interesting. You have a number of individuals that have embedded gains on the long side of these individual stocks, and some individuals like to hedge. May not want to sell if it's in a taxable account to hedge their gains. So we have a non-leverage inverse that you may want to hold longer or potentially to because it's a non-leveraged inverse. You still have to monitor day to day, periodically, whatever your hedge is going to be and ratio-wise, you have to monitor that on a regular basis. But we've seen some individuals use the short to hedge against some of the gains to protect them, I should say. Or if they feel that some of the PEs are overvalued right now in some of the Magnificent 7 that we have available to them, to just play the short side, again, where they don't have to borrow stock. You don't have the unlimited liability when you're packaging it through an ETF. So, we have different ways where a number of clients are utilizing in different formats. And those are just some examples there.
Interesting. So, Ed, your Tesla fund, TSLL, became the first single stock ETF to top $1 billion in assets under management earlier this year. Why do you think that particular ETF blew up so much? And do you think any of your other single stock ETFs could reach those heights?
I think Tesla is just its own entity unto itself with Elon Musk. It's a polarizing stock. It has almost like a cult following to that. And it's also always in the headlines, it seems, one way or the other. So I think that definitely there's been a lot of interest right off the bat with that pair in particular. Do I see some of the others that we have within the Magnificent Seven? Maybe garnering more interest. Yeah, definitely, depending on the environment and the stock headlines. You may see some more interest there. We've seen some good tractions in some of the other ones. It just hasn't been to the magnitude of Tesla. Nvidia, we just launched also more recently to round out the 6 pairs that we have within the Magnificent Seven. And of course, Meta is the one we don't have as of yet. So we're seeing some good interest overall. And the volume definitely picked up in all of these around earnings time, as you can imagine. So if you look at the average daily volume, for the most part, you saw significant increases pre and post earnings on those individual stocks.
Well, we're going to have to leave it there. Ed, it's been an absolute pleasure having you on the show. Thanks so much for your time.
Thanks for having me.